This is not a drill. This is official confirmation straight from the Department for Work and Pensions. And if you're receiving state pension in the UK, December 8th is a date you need to circle on your calendar right now, because that's when major changes to state pension payments officially take effect. And what's landing in your bank account is going to look different from what you've been receiving all year. The DWP has just released the confirmed details about what's changing, who's affected, how much money you'll actually receive, and the exact payment schedule for December 8th onwards. This isn't speculation anymore. These are locked-in figures that every UK pensioner needs to understand, because this directly affects your weekly income, your monthly budgeting, and your financial planning for the next 12 months at minimum. Here's what makes this announcement so significant. The changes taking effect on December 8th include the new state pension rates under the triple lock. Increase that's larger than many experts predicted, adjustments to how certain components of state pension are calculated that affect people with incomplete national insurance records, changes to the payment dates for some pensioners due to system updates, and critically corrections for groups of pensioners who've been underpaid that will result in backdated lump sum payments, arriving alongside regular December payments. What the DWP has confirmed is that December 8th is specifically when these changes go live in their payment systems, which means if your regular pension payment date falls on or after December 8th, you'll receive the new increased amount. If your payment date is before December 8th, in early December, you'll get one more payment at the old rate, and then your next payment after that will be at the new rate. Here's the part that's causing confusion and concern among pensioners across the country. The DWP's announcement about December 8th includes several different types of changes happening simultaneously, and they haven't done a good job of explaining which changes apply to which pensioners. Some people are going to see their payments increase by the standard percentage uplift. Others are going to see additional increases because they fall into correction categories. Some pensioners will see their payment dates shift by a day or two due to system changes, and a small number of people might actually see decreases if they were previously being overpaid, and those overpayments are now being corrected. The lack of clear, personalized communication from the DWP means millions of pensioners are left trying to figure out from generic announcements whether these changes benefit them or harm them and what they need to do about it. That's unacceptable, but it's the reality we're dealing with, which is why I'm breaking down every aspect of what's been confirmed for December 8th, so you know exactly how it affects your specific situation. Hit that like button right now if you're a UK pensioner who deserves crystal clear information about what's changing with your state pension on December 8th. And let's go through the official DWP confirmation so you know precisely what to expect in your bank account. All right, let me start by explaining exactly what December 8th represents in the DWP's payment system and why this specific date matters so much. Because I know there's been a lot of confusion about whether this is when payments arrive or when changes take effect, and getting that distinction clear is absolutely crucial. December 8th is not necessarily the day your money lands in your bank account. It's the date when the new state pension rates and calculation methods are activated in the DWP's computer systems. What this means practically is that any state pension payment that's processed on or after December 8th will use the new rates and the new calculation methods. For most UK pensioners, state pension is paid every 4 weeks, and your specific payment day is determined by the last 2 digits of your national insurance number. If you're paid on a Monday and your payment date happens to fall on December 8th or any day after that, you'll receive the new increased rate. If your payment date falls on December 1st, 2nd, 3rd, 4th, or 5th, you'll get one final payment at the current rate, and then your next payment 4 weeks later will be at the new rate. This is why December 8th is significant as a kudo off date rather than being the universal payment day for everyone. Now, let me give you the actual numbers that have been confirmed by the DWP, because this is what you really need to know. The full new state pension, which applies to people who reach state pension age on or after April 6, 2016, is increasing from $23.85 per week to $221.20 per week. That's an increase of 17% $15.35 per week, which works out to approximately $75.18 per month if you're paid monthly or 92 loans per year. For a pension, a couple where both people receive the full new state pension, that's an extra $1,140 per year while coming into your household. For those of you on the old state pension system, which applies if you reach state pension age before April 6, 2016, the basic state pension is increasing from $15,620 per week to $16,950 per week. That's an increase of $1,330 per week, which is approximately 57 levies 63 per month or 69,160 per year. Many people on the old system also receive additional state pension on top of the basic amount, and those additional components are also increasing by varying percentages depending on which specific element you receive. The reason for these increases is the triple lock mechanism, which guarantees that state pension rises each year by whichever is highest out of inflation average earnings growth, or 2.5%. For this year's increase, it's the earnings growth figure that's driving the rise. Wages across the economy have grown by 8.5% over the relevant measurement period, and that's what the state pension increase is based on. This is one of the more substantial percentage increases we've seen in recent years, which is why the actual pound amounts are quite significant. Now let me talk about the changes to calculation methods that are also taking effect on December 8th. Because this is where things get more complex, and where some pensioners might see different outcomes than others. The DWP has been reviewing how state pension is calculated for people with incomplete national insurance records, and they've identified some inconsistencies in how gaps and partial years were being treated. The new calculation method that goes live on December 8th is supposed to be more accurate and fairer, but in practice it means some people's pensions are being recalculated. For most pensioners who've been receiving state pension for years, this recalculation won't change anything. Your pension amount is locked in when you first claim it, and subsequent changes to calculation methods don't usually affect existing pensions. However, there are specific circumstances where recalculation does happen. If you've recently claimed state pension within the last year or two, and there were questions about your national insurance record, your pension might be recalculated under the new method. If you deferred claiming your state pension and you're claiming it now, the new calculation method applies to you. And if you've had corrections made to your national insurance record recently, such as adding missing years or claiming missing credits, those corrections might trigger a recalculation under the new method. The impact of these recalculations varies. Some people find their pension increases because the new method treats certain gaps or partial years more generously. Others might find their pension stays exactly the same because the two methods produce the same result for their specific circumstances. And in rare cases, someone might find their pension decreases slightly if the old method was giving them credit for something the new method doesn't recognize. Though the DWP has said they're applying protections to prevent anyone losing money due to calculation changes. Let me address the payment date changes that are happening for some pensioners because this is causing anxiety for people who've had the same payment day for years and suddenly they're being told it's changing. The DWP is updating its payment systems, and as part of this update, a small percentage of pensioners are having their payment days shifted. Most people are not affected by this. Your payment day stays the same as it's always been. But if you're one of the people whose payment day is changing, you should have received a letter from the DWP explaining this. The reason for these shifts is technical and relates to how the DWP distributes payment processing load across different days of the week. If too many people are concentrated on one payment day, it creates processing bottlenecks, so they're rebalancing the distribution. If your payment day is changing, the letter you receive will tell you what your old payment day was and what your new payment day will be from December 8th onwards. The key thing is to watch for that letter and make note of the change so you're not panicking when money doesn't arrive on the day you expected it. Now let me talk about the correction payments for historical underpayments, because this is where some pensioners are going to see substantial lump sums arriving in December alongside their regular payments. The DWP has been running systematic correction exercises after discovering they underpaid certain groups of pensioners over many years. The main affected groups are married women whose pensions should have been uplifted based on their husband's national insurance contributions, but weren't. Widows and widowers whose pensions should have increased when their spouse died, but didn't. And people over 80 whose pensions should have automatically increased at age 80, but the increase wasn't applied. December represents another wave of these correction payments being processed. If the DWP has identified you as having been underpaid, recalculated what you should have been receiving, and determined that you're owed money, that payment is scheduled to go out in December. The amounts vary enormously depending on how long you were underpaid and by how much. Some people are receiving a few £100s, covering a year or two of underpayment. Others are receiving tens of thousands of pounds, covering 10 or 15 years of substantial underpayment. If you receive one of these correction payments, it will arrive as a separate transaction from your regular state pension payment, and you should receive a letter from the DWP explaining what the payment is for, how it was calculated, and what period it covers. The letter should also explain whether any tax has been deducted from the payment and what your new ongoing pension rate will be going forward now that the error has been corrected. Here's the frustrating part that I need to address. Honestly, the DWP's identification of people who were underpaid is not complete. They're using computer algorithms to search through millions of pension records looking for patterns that indicate underpayment. And those algorithms are finding a lot of cases, but they're not finding everyone. There are pensioners who were underpaid, who haven't been identified by the automated systems. And unless those people proactively contact the DWP and ask for their cases to be reviewed, they'll continue to be underpaid and they'll never receive the correction payments they're owed. If you're a married woman who reached state pension age before April 2016, you should check whether you're receiving at least 60% of your husband's basic state pension. If you're receiving less than that, there might be an error. If you're a widow or widower hour and your state pension didn't increase when your spouse died, that's a red flag. If you're over 80 and you didn't see your state pension increase when you turned 80, you've almost certainly been underpaid. In any of these situations, you need to call the pension service on 0800-731-0469 and explain your circumstances and ask them to review whether you've been receiving the correct amount. Let me talk about how these changes interact with other benefits you might be receiving, because state pension doesn't exist in isolation, and changes to your state pension can have knock-on effects. If you're claiming pension credit, your state pension increase will reduce your pension credit slightly, because pension credit tops up your income to a guaranteed minimum. When your state pension goes up, you need less pension credit to reach that minimum. However, your total income still increases overall because the state pension rise is larger than the pension credit reduction. If you're receiving housing benefit, council tax reduction, or other means-tested benefits, those benefits are based on your income and your state pension is counted as income. When your state pension increases, your means benefits might decrease slightly. Again, you're not losing out overall. Your total income goes up. It's just that the increase is shared between higher state pension and slightly lower means benefits. If you're receiving non-meansed benefits like attendance allowance or personal independence payment, those are completely unaffected by your state pension increase. One concern I'm hearing from pensioners is about tax and whether this state pension increase will push them into paying tax when they weren't paying it before, or whether it will increase the tax they're already paying. State pension is taxable income, but no tax is deducted at source from your state pension payment. If your total income, including state pension, is below the personal allowance, which is $12,590 per year, you don't pay tax. If your total income is above that threshold, you owe tax on the amount above it. The state pension increase means your income for the tax year is going up by around $900 if you're on the full new state pension, or around $690 if you're on the basic old state pension. For some people who are currently just below the personal allowance, this increase will push them over it, which means they'll start paying a small amount of tax. For people who are already above the personal allowance, the increase means you'll pay a bit more tax than you were paying before. HMRC collects this tax either by adjusting your tax code if you have other taxable income, like a private pension, where tax can be deducted, or by sending you a tax bill at the end of the year if your only income is state pension. Let me address what you should actually do in response to these December 8th changes, because some people need to take action and others just need to be aware and check their payments. If you're a typical pensioner who's been receiving state pension for years with no complications, you don't need to do anything. Your December payment will automatically be at the new increased rate if it's processed on or after December 8th. Just check when the payment arrives that it's the correct amount based on the new rates I've given you. If you think you might be in one of the groups affected by historical underpayment, you need to contact the pension service and ask for your case to be reviewed. Don't assume that if you were underpaid, the DWP will automatically identify you and contact you. Many underpaid pensioners are not being identified by the automated systems, and you need to be proactive about checking your own situation. If you received a letter saying your payment day is changing, make sure you've noted the new payment day and adjust your budgeting accordingly. Set up text alerts or banking app notifications so you know when money arrives in your account, because if you're expecting it on a Tuesday and it actually arrives on a Wednesday now, you don't want to panic thinking something's gone wrong. If your state pension amount has always seemed lower than you expected and you've never understood why, December is a good time to call the pension service and ask for a full explanation of how your pension was calculated. They can access your national insurance record and walk you through exactly which years count as qualifying years, what gaps you have, and how those translate into your pension amount. Understanding your pension properly means you can identify if there are errors or omissions that need to be corrected. Let me talk about the broader context of what's happening with UK state pension, because December 8th changes don't exist in isolation. They're part of ongoing challenges and reforms to the pension system. The state pension age is still rising, currently at 66, but scheduled to increase to 67 and eventually 68, which means people are waiting longer to receive their pensions. The triple lock mechanism, while beneficial in years like this when there's a large increase, is politically controversial, and there are always questions about whether it's sustainable long-term or whether future governments might scrap or modify it. The administrative challenges at the DWP, evidenced by the historical underpayment errors that are being corrected now, show that the systems managing pensions are not as robust as they should be. Mistakes happen, payments are wrong, and the burden falls on pensioners to check their own entitlements and challenge errors rather than the system proactively ensuring accuracy. This is unacceptable, but it's the reality, which is why I'm always emphasizing that you need to be your own advocate and verify your payments. Looking beyond December 8th, your state pension will continue to be uprated every April under the triple lock system, assuming that policy continues. The percentage increase each year depends on which of the three measures of the triple lock is highest, and that varies from year to year. In some years, you get above inflation increases like this year. In other years, the increase might be smaller, but the principle is that your state pension maintains its value in real terms and doesn't get eroded by inflation over a long retirement. Before I finish, let me give you the key takeaways. December 8th is when new state pension rates and calculation methods take effect in the DWP system. If your payment is processed on or after that date, you get the new increased rate, which is $221.20 per week for full new state pension or $169.50 per week for basic old state pension. Some pensioners are also receiving correction payments for historical underpayment. And if you think you might have been underpaid, you need to proactively contact the pension service to have your case reviewed. Check your December payment when it arrives to verify it's the correct amount. If your payment day is changing, watch for the letter explaining your new payment day. Understand how the state pension increase might affect other benefits you receive, particularly means ones like pension credit. And be aware that the increase is taxable income, which might affect your tax position. Most importantly, don't assume the DWP has everything correct. Check your own entitlements, verify your payments, and challenge anything that doesn't seem right. You've worked your whole life and paid into this system. You deserve every penny you're entitled to, and it's worth taking the time to make sure you're getting it. Thank you for watching, and I hope this breakdown of the December 8th changes helps you understand exactly what's happening with your state pension.